Hello, I hope everybody is well. I'm Kojiro. Welcome to my channel, Good Vibration. If you have not yet subscribed to this channel, well, click the logo here to subscribe now or anytime along the video. Along the years, I came to conclude that a winning trade is directly related and proportional to having a good entry into the market, when you enter your position. The entry point is probably one of the most important things in all trading. Many traders tend to underestimate or undervalue this component of the trade, which I'd say represents between 80 or 90% of the success rate of every trade. In other words, and to any extent, the more precise you can be forecasting the correct entry level of time and of price, the more profitable and successful you are going to be as a trader. And it doesn't matter if you scalp, if you day trade, if you trade short term, mid term, or long term. If you have a good entry into the market, your chances of success will grow exponentially. And it is even more crucial to small and retail traders, which don't have massive accounts. And for most of us, it is almost an obligation to learn and to master the correct entry into a trade. Like snipers. The game is about precision. One shot, one kill. And that has to be your edge in the markets. In the other hand, big banks, financial institutions, hedge funds, they don't really need to be that precise because they work with very, very large accounts that allows them to scale in and out of their positions, in and out of the market. So, precision in that case is not really a decisive factor in their trading. They could be more profitable if they were more precise, but for us, small and retail traders, it is a must. So I think much of the learning and of the effort in the learning and practice should go into mastering this, into learning this well. Anyway, it is not easy to achieve this. It takes a lot of time and a lot of practice. And it is easier said than done. Okay, let me show you some trades to see what I am speaking about. Okay, I'm trading here the S&P Micro S&P 500 futures. Place an order to go short. Okay, you entered there already. And I have 2 contracts going short, 8 ticks of stop loss, and the first contract it's at 8 ticks, and the second contract it is 20 ticks. So it is a 2-stage trade. Alright, fast forward there 3 minutes. So okay, we are out in the first contract. We have 8 ticks, $10, and now we're going for the second contract down there. Should go down there. And it is always convenient and good that the price moves into positive territory as soon as possible when you enter a trade. This is a positive sign that the impulse is in your favor. But if the price, starts going wildly against you, then you didn't enter at the correct place. Anyway, I do believe the stop loss shouldn't be too wide or too long. But logically, you should give it a little room to maneuver. There I tighten the stop loss. I usually Usually use 8 ticks of stop loss in my trades, and well, that should be more than enough. And another very important thing to keep in mind is never ever move your stop loss once you enter a trade. And well, you can move it into positive territory, as I did right there, to tighten the trade and secure a portion of the trade, but never ever move it back to widen your stop loss. Because, you know, once you're in a trade, because chances are that if it went against you by that much, you are already probably wrong in your analysis. And well, if you move it back, you are opening the door to big losses. And if you get used to doing this, at some point you will end blowing up your account. And this is a very common mistake everybody makes when they start trading. So well, as soon as it reaches more than 60% of the distance to my take profit, I'm going to tighten more my stop loss. So yes, it is better to lose what you had already planned from the beginning. You place your stop loss, you already know how much you're going to lose, and always stick to your trading plan, always. Well, the challenge should not be to widen the stop loss, but having a great percentage of your trades positive as soon as you enter, and well, becoming good and proficient at this. And this way you will always be, at the end and in the long term successful. Okay, here we go with tighten the stop loss into positive territory here, and that is okay to do. And well, this is what I call a zero risk trade. And we're gonna go for those 20 ticks there, $25. Okay. You have to have patience, and notice that we enter at the top of the second leg down, that swing point there. That's a good place to enter. And it really okay. Going out. We're going out. And it never went against me more than around 5 ticks, I think. And notice the impulse. The impulse should always be big in your favor. That's what I am talking about. And you have to practice and train, to always enter in this way every trade. And if you get, okay, we're gonna. There we go. A little bit more. One thing. Okay, we're out. But this was a good trade. 2 contracts to 24 ticks in total. $35 in over around 8 minutes. Okay, here's the second trade. Here we go. This is the mini contract, and one mini contract is worth 10 of the micro contracts. This is also the S&P 500 futures, and in my calculations, okay, we enter here. We're going long now to the upside. My calculations tell me that we have a change in trend already, so we're going to enter the second leg up. We are already positive. You notice only 1-2 ticks it came against me, and we are off. We are to the upside, positive already. And I am able to catch the swing points with a great deal of accuracy using the law of vibration, because it shows me the change in impulse or change in trend before they actually happen. So it is a supreme tool or method when entering a trade that gives a great edge, over the market. So if you notice, you get to enter first into a swing, into the trade, and you also get out first before other traders do, because most of the traders will wait for confirmation. They will wait for a bar, a bullish bar in this case, that tells them, okay, you're okay to go. When we enter in this case, it was a volley there, at the bottom of the volley, and we're going long. But we can enter the peaks and the valleys. That's the best place to enter. But of course, you have to have confidence that your calculations are right. Very positive here, and I'm gonna tighten my stop loss a little bit more here. So this is a zero risk trade, and well, that's what I'm talking about. Trained to be able to do this in a consistent basis. It is not easy. I'm gonna tighten my take profit also here, and well, I'm gonna go down here because the next bar should be red. So there's gonna be a change in trend here, a little impulse down, correction. I'm gonna tighten here. So after this green bar here, the next bar should be red. So it's better to get out here. So we catched all the swing. Okay, here we go. And let's see. One a little bit more. We have where it was a good trade there. 20 ticks, $150 in like around 4 minutes. And this bar should close red. That's why I got out there. Okay, then this is due to the law of vibration. The change in impulse, in force, in energy, in a trend. So you can see all the pivot points before they actually do happen. Okay. And well, another thing to keep in mind is the risk to reward ratio, because the risk to reward ratio should be more than 1-to-1, always. Okay, let's go to the next trade here. Here, this is also the S&P 500, the mini contract. And in this case, I am going to go short in here. I'm gonna place my order around here. It should be a good place to enter due to my calculations, and we are going to go short. There we go. And again, well, the stop loss is 8 ticks, and I'm moving my take profit V2-to-1. And it should go more, should go down more than 2-to-1 in this trade. This next swing there. And well, notice the impulse. in my favor as soon as I enter, and that's what every trader should look for. Well, it is not easy to master this, but you know, I'm gonna give more room. Here we'll have a 3-to-1 risk to reward ratio. This will be around 24 ticks. You'll get down there to take profit for a $300. Okay, there we go. So when it crosses more than 60%, you're good to, you know, to tighten your stop loss. Then you have a risk-free trade. There we go. And then, well, have patience. Let the price action roll. And well, there we go. And you know, you only need a couple of these a day. You know, 2 or 3 good trades, and you're set to go. That's all you need. So you end your trading day, well, in one hour if you're lucky, but you know, maybe 2 or 3 hours is kind of slow, because you know, swing points intraday there are a lot of. And well, this also works, you know, in longer time frames. But well, it's better to be out. In my opinion, it's better to be out of the market, because the time you're in the market, you are risking, you know, your investment there. But if you win, okay, there we go. Okay, that's it. Nice trade, 24 ticks, $300 in around like 3 minutes. Okay. Oh well, very nice. Okay, I hope you like this content, and if you did, well, give me a like, and don't forget to subscribe to my channel.